Okay, everyone, welcome to this 30 June tax and SMSF strategy session. I make no bones about this is going to take a lot, so I'm going to pack in a lot for 30 June. Each and every year, it gets so much bigger and so much better. I've got a few good tax planning strategies, but I've also got a lot of SMSFs. It seems more and more that we're driven towards the superannuation SMSF side. So as is normal, this session will be recorded and will be available with a whole lot of add-ons coming up within the next 3 or 4 hours, I hope. Online, I've got our team, both Daniel and also I've got Ashley and also Michael Jeffries. And they're both going to answer any questions. So either jump on the chat line or the Q&A saves me, because all I have to do is just focus in on start smashing things out. Now, I can tell you this is a lot different webinar than I would have been doing with the Labor opposition had been in power. And as you can imagine, there would have been nightmares for all of us. But as I said, and you've heard me before, you're going to hear me again for the next 3 years, do not waste a day. This is our opportunity to really build up our SMSF book. First off, don't ever listen to polls again. After Brexit, after Trump, and after Morrison, polls are virtually worth virtually nothing as far as I'm concerned. So let's just get in there, look for our clients. The key things, the 3 key things you need to bang on about your clients all the time is the strategies you're doing for them, whether it's a leading member like a lineage or bloodline planning, whether it's any of these tax planning, whether it's an ABP with some pretty good estate planning built on. They're there for safety, security and certainty. So safety, security and certainty, because people over age 60 essentially want that. And I'm a great one for this retirement incomes policy. I read this morning that Martin Heffron was rolling his eyes, but it was just another, commission or a study. But for me, I'm absolutely all for it, particularly after the absolutely diabolical, disastrous refundable franking credits. If you don't get that on and look at that in terms of the policy, then we're all in strife. Anyway, year-end tax time, can you believe it? We're 3 weeks out, not even that, I think. And of course, things will get crazy. Here's my first tip and trap. The year-end is 30 June this year, which creates a lot of problems. Good, it means that 1st of July is on a Monday, so we can get stuck in and do our investment strategies and our minimum pensions, etc. But effectively, 30 June is on a Sunday, so many of you may be working that long weekend. So first and foremost, if you haven't got the cash at that late stage and you still want to make a contribution, use a Light Year Docs promissory note. Short term only, probably covers maybe maximum 2 to 3 months maximum, preferably just a few weeks. But if you haven't got the cash, you can put it in and then redeem it later for cash. So absolutely crucial. If you're running out of that, pump it out. And then essentially go through the track, because we don't know how quickly money is transferred over the internet will end up in the super funds bank account. If it doesn't hit the bank account, it is not a contribution. The last thing you want to do is all these strategies and find out that effectively you're going to have that contribution is going to be waylaid to the next financial year. Whereas a promissory note is as soon as it is received by the trustee. So again, we've got minutes and all of that sort of stuff. But there's my first 30 June trap, but also opportunity. So this is, for me, this is a time we can make a real difference to our client's tax position. Look, I'm not sure how business has been for you or for your clients, but some of them obviously done quite well. Some are borderline. If you're not doing too well, then tax strategies are immaterial, really. You may end up have losses. So there's a real difference to a client's tax position. If we can include superannuation, then we can increase their long-term wealth. It's time for all of us to get our strategist hats on. So I love this last 2 to 3 weeks of the year. Unfortunately, it'd be great to go in and deep dive into every client's affairs and sort them out, but it is just not possible. As is usual, just because it's tax time, there's good, but there's always bad. And so what we've got to watch out for is particularly accountants or to a lesser extent planners who don't do the right thing, don't get in touch with their clients, and the clients end up with a big tax bill, or fail to basically do some of the basic tax strategies right. Anyway, time's of the essence for all of us in this session, so let's go. First off, I just want to give a quick plug. This is a CPD, it's a free CPD. You do get a CPD hour for this. It's going to be recorded. You will get a survey after this. And if you complete the survey, it's beneficial for SEA, for the FPA and also the SMSF Association to show that you have been here throughout this 1 hour in order for you to get one for SEA hour. And I think I've seen the SMSF Association has now moved to hours, which is, thumbs up and well done on them. I'm not sure about the FPA at this stage. The CPD is recognised by FPA and also SMSF and for SEA. For I Love SMSF, jump on the portal if you'd like, or you can see throughout the slides today, there's Grant at ilovesmsf.com or Daniel at ilovesmsf.com. Feel free to email us. But essentially we do up to 6 hours per month. So you can see some of the free, but we keep all our juicy strategies, our work-throughs, our case studies, and more importantly, do at least 1 to 2 Q&As a month. Next week, I'm doing a session on life values consulting, which is a great consulting technology technique that we'll be doing for our strategists and our family SMSF advisors that will really make a huge difference to your business. But look, if there's just yourself, a single person, what I mean by that you're just a sole practitioner, then have a look at our 1-year CPD, which has got a bi-monthly strategist, which is worthwhile. That's going to give you at least probably 25 for SEA hours, which is certainly a great start for next financial year. You only need to get another 15. It's all top quality. I've written the whole stuff. You hear my webinar, and that's only $4.95. So if you'd like to get in before 30 June, and for a firm, it can be as low as $2,000, also $2,200 per month. So have a look at that. Okay, so let's have a look at some of the nasties before we get into some of the juicy ones. We should all be aware that obviously we need to make sure that we do our distribution minutes prior to 30 June. I know many accountants leave it until post the event when you do the income tax return. But if you look under the law, if you do get audited at some point in time, the commissioner will put his hand up and start auditing these things. It is the law to get the distribution minutes out and about. If you fail to do so, then top marginal tax rates will apply. And I would envisage that there would be an action against the trust account, particularly when we have a look at the Cam and Bear case last year, where the auditor got pinged for simply putting an incorrect loan liability as a cash liability in the accounts of the fund. So negligence has really opened up against financial services professionals at the back end, which is audits, and obviously the pointy end with accountants and financial planners. So make sure you get your distribution minutes in, not only for yourself, but also for all of your clients. Michael Jeffries, who's one of our directors, has had extensive experience in this and has built our trust distribution minutes, having a look at everything he's seen over the last 20 years. So we've got some pretty good, strong, secure and certain trust distribution minutes that cover capital gains tax, franking credits, even offshore credits as well. So you can stream all of that. Absolutely brilliant. So have a look on that on the Like Your Doc site. It's only $49 per distribution minute. Certainly don't hand out Xeroxed or photocopies to clients and get them to fill it in. That's just, it just doesn't work. As I said, Thursday we have a webinar which talks about trust distribution. It's promissory notes, so make sure you sign up for that. That'll come out in your notes. Division 7A must be heeded. Have payments been made, and really you need to look at next year agreement. Is it going to be changed? Are you simply doing rolling agreements, or are you choosing the 7-year or the 25-year? Our Div 7A agreements will be out next week for you. And again, let's have a look at some more tax strategies. I'm sending you through a 6-minute video from Tim Munro of Change Accountants, and he goes through quite a number of tax strategies, not so much superannuation, but tax strategies. He loves using bucket companies, particularly for high marginal tax rate taxpayers. Certainly anyone who's 30% or above, he loves using bucket companies. One is it at least solves the position of having to make distributions. They get caught in there. Obviously, you're going to have to pay tax. You get your franking credits, but they can then be distributed at a later stage. So they're really cool. I just want to give you a bit of a heads up on a pretty aggressive strategy that happened many years ago. I know the Commission did a bit of a warning on it, but certainly there's been nothing out and about on it since then. Particularly if it's been left in for a while. Bucket companies being transferred into SMSFs. Obviously goes in, you have to work out your valuations because it's going to be a contribution or an LRBA depending on what your NCCs and your clients' concessional contributions are. But putting it into an SMSF and you say, well, Grant, you can't do that because it is an unlisted company. Well, generally not. If the only thing in there is cash and franking credits, well, yes, you can because it's classified as a 1322C company and can be transferred by related parties into our SMSF. In fact, I've done a couple of these, not for bucket companies, but for companies with business real property in them. Have a look at 1322C. There's certainly regulations around that. I've just got to be careful about it's got no borrowing, cash. It can't have entities, so it can't have, for example, any securities or stocks in there. But when it goes in, obviously, the benefit of that was that franking credits would be paid out through the distributions or dividends from the bucket company. Look, again, have a look. There's Commissioner's ruling on that. If you want to know a bit further, please feel free to call me. You've got, or go to my email, grant@ilovesmsf.com. Again, bucket companies are useful. So make sure that they keep there. We can also use the bucket company as a great tool for LRBAs. When we come down and we need to do a related party loan, thank goodness that's still going to be around for the next 3 years. Fingers crossed that we've got 6 years with Morrison, that effectively those related party loans. And with NALI, you're going to find that the Commissioner's guidelines 2000 or PCG 2016/5 is a good start. But NALI will cover all the unlisted investments like 1322Cs, those sort of things. But one of the entities that could be quite useful for us is going to obviously be, we've got bucket companies there that can provide the finance, which is fantastic. Prepayments are also important for us. Tim offers, I love this one, Tim offers his clients a discount to make payments. He said last year through prepayments he ended up getting, sorry, just shutting the door on the dog there, sorry about that. He got prepayments of his fees for $160,000. So particularly for doctors and dentists and other professionals who were looking at obviously getting rid of some excess taxable income. So again, it's not a bad idea, like the prepaid fees. So certainly look at if you can do that as well. Deferring income is pretty obvious, which is crucial. And also, well done, Tim, you're on there. In fact, he's saying he doesn't allow the clients a discount. He just offers them to prepay. So thank you, Tim. And again, we'll be showing the whole video there for Tim. We'll be sending out. And if you've got a few ideas, he's also got some great little strategies with capital protected equity products as well. So have a look at that. Tim's more than happy to take your calls. And also he's got a good seminar coming up in September the 2nd, I think, up in Brisbane, which I'll be speaking at. So make sure you come along to that. And of course, don't forget the instant asset write-offs this year, which is $30,000. And isn't that amazing? So I've seen, I live up in the Sunshine Coast now. We've got Cricks Autos and all that. Got great specials on it. Suddenly, it's amazing how all their cars just pop in under the $30,000. But, you know, my thing is if you don't need a car, you don't need a car. One of the things that Tim said, and again, I'll refer you back to the video, is it is probably pretty important to keep tax and accounting depreciation quite separate, particularly if you've got an instant asset write-off, because it'll make the books or the accounting books a lot worse off. Or when you do sell, make sure it's an EBITDA. SMSF and tax and super strategies. Pension payments, watch out for your pension payments. If you don't pay the minimum, then obviously what happens from there is that's treated as an accumulation. So you aren't able to use the exempt pension tax component. So you just got to make sure that minimum is paid. Doesn't necessarily have to be paid in cash. You can use a short-term, a promissory note. So effectively, if there's a promissory note, there's a promise to pay it out through a PN, and then at a later stage, just fill that up with cash, particularly if you haven't got the liquidity in the fund. Or remember, it is 30 June. So those PNs can be done up to the last minute at 30 June. So watch out for that. For TRIS, you've heard me before. I only believe TRISs are short-term vehicles. If you don't know how a TRIS works under the new system, it forms part of the accumulation account. So if I've set up a TRIS this year or a prior year, then what will happen is it fits into a little subset of our accumulation account. Now, I can't add to a TRIS directly. So if I put in contributions, or I put in SGC this year or contributions, effectively I can't just add that straight into a TRIS. The TRIS has to be quite a separate amount. It's a separate contract. And so those contributions sit outside, which is a pain in the neck for the accountants, because you need to run or look at two quite separate accounts in there, which is, well, to me, it's a bit painful. What I'd say is, look, TRIS is essentially, now that it's really just a subset of an accumulation account, you're better off just using it, pulling your money out that when you need, like if it's between 4% to 10%, and then effectively just using it for the client and then winding it up. So that if you have got clients who have got contributions or making contributions into their accumulation account this year, and they've already got a TRIS, one, if they're over age 60, make sure they've met a condition of release, which is just give up one form of gainful employment, and then effectively you are off and racing. So then you won't need a TRIS anymore. You'll have an account-based pension. But if you are in a TRIS, then simply cease the TRIS prior to 30 June, and then that will fold the TRIS back. If you go to the Lightyear docs, in fact, we'll probably do some stuff on Thursday, but if you fold it back into your accumulation account, the TRIS effectively ceases. So it's not going to have a T-bar effect, so there's no credits or debits because it sits outside of the T-bar. So what I would suggest, again, these are not super tax strategies, but they're just smart things to do at year end. Fold that TRIS back in, start to aggregate with all the contributions you've made, and then of course on the 1st of July, guess what you do? You start another TRIS, unless of course you've got a contribution suspense account. You want to make sure you download from the contribution suspense account, then start up the TRIS once that is done. For pensions, if you want to start a pension this year, it's not a bad idea. It is going to boost your exempt income component, and we're pretty late in the day for it. Depends on whether you can hoodwink the actuary, but they're all pretty smart. But if you could set up a pension this year, then effectively there's no minimum payment required. So you don't need to draw cash out, but it'll flip over to the next year. So it's not a bad idea thinking of some exempt income in order to minimise our tax payable inside our fund. But this is a long-term one, and this is one I generally highly recommend. The government is going to make changes to segregation and segregated pension assets, which is a good change for me. One of the ones, though, is if you think long-term, particularly those of you who've got clients who are both in the pension and also the accumulation stage, sorry, Lloyd, thank you, is talking about estate planning as well in relation to the TRIS. So thank you very much for that. Watch out for that, and I'll cover that a little bit later on. So again, thank you, Lloyd. For pensions, if we take it down the track, so we've got clients who've, particularly in the past, they've got their pension going ahead, and they've also got their accumulation running at the same stage. Now, we could run a pooled investment strategy for that fund, which it's not a bad thing to run there. But remember, we are going to, long term, this is going to get a little bit sophisticated. So if you're not up with me, please tell me. I'm just going to walk through this for a couple of minutes. So what happens is I have, for example, $300,000 in an accumulation account and $1 million in a pension account. So everything's A-OK. I'm just using those as elaborative rather than obviously T-bar illustrative. So I've got 300 in accumulation and I've got 1 million in a pension account. Now, as I go down the track, if I've already hit up the T-bar, so my pension account's gone down to 1 million because I've been drawing money out, I've got my 300 sitting there in the accumulation side. Now, when I come around and doing my investments and investment strategies, effectively, if I can put my high growth assets or a good growth, so if I'm looking at the total fund and I've got growth assets, I could put them over on the accumulation side. The problem that I have on the accumulation side is that if they're stuck over there, when the member dies, if the member dies the following day, then those high growth assets, if they're going to be realised by the trustee of the fund or they're paid out in specie, then effectively what would happen is that there'd be a capital gains tax. And if they're going to adult children, then obviously there's a 17% on taxable contribution. So it's effectively like a double death duty, which is probably not the best way of going. Whereas if I've got those growth assets that are sitting over in the pension account, then in that pension account, what happens there is two things. So if I get the growth on the pension account, then effectively one is it's increasing the underlying pension account over a period of time. Now, I'm not an investment strategist, so I can't guarantee growth at any time, but I'm talking thematically. What will happen though is if I put the growth on the pension side versus the accumulation side, then it means my underlying account balance for my pension will increase by the proportion of the growth assets versus that on my accumulation. In fact, I might be better to just take my pension minimum from obviously the pension side and any excess obviously take from the accumulation. And what that does though is by putting the growth assets, if the growth in the underlying pension assets are greater than those in the accumulation, then by its very nature, when the actuary comes around to doing its determination, you're going to find that the pension assets are a greater percentage. And it might make a big difference, but it certainly makes a significant difference over a period of time. Likewise, we could also, for those of you who are super pension strategists, and you would have heard me talk about this before, that we may end up with 2 or potentially 3 pensions inside the fund, all with different tax componentry. So, for example, we might end up with a transfer of a business real property into a fund. We're able to use the 15-year capital proceeds rule so that when that goes in, it's tax-free. If I start a pension straight away, assuming the accumulation count when it's dumped in, there's nothing in there, then effectively I end up with a tax-free pension. As opposed to many of us who've got our money in accumulation when we start a pension, it's going to consist of, in part, some tax-free, some taxable, but mainly taxable components. So if we've got 2 different pensions running with 2 different taxable components, again, the tax-free one is perfect for adult children, whereas the one with the taxable component is mainly for our spouse. Although I do query whether it's worthwhile putting the spouse if she's already hit the T-bar as well, but also other dependents, and you've heard me talk about that a little before. But essentially, if I've got that stage running, then I can actually start to pull down from one or the other, and I can put growth assets in one or other of those pensions. So not only can I run separate investment strategies between allocation and pension, but I also can run it between various pension accounts. Again, it's a little bit of a workaround from administration perspective, but it can make a significant tax difference in the long term, and of course, quite a lot of estate planning differences. SMSF and super tax strategies, some more. Make sure that if you have got your plain vanilla pension payments coming out of one pension account in your super fund, just take the minimums and make sure that anything else is a commutation payment. You'll see the difference if you have a look in our light year docs. We actually have their pension commutations so that you can total the whole thing up and say, look, this is a pension commutation. Generally, it's best to do at the present point in time, or you can simply do it for the any amount over the minimum pension for the year. So when it comes down, it's a commutation payment. Again, it's tax-free. The main thing there, though, is it acts as a debit to the T-bar. So if a client doesn't need an amount over the minimum, then obviously we want to debit the T-bar. Now, if they've got existing contributions in there, that enables us to feed that money back into the pension system. Or alternatively, if we've got already money going in for accumulation, we're over the amount. Sometimes it's hard because we might have met a condition of release being retirement for our original pension, but we're still making contributions in and we haven't met another condition of release there. So we have to draw down from our T-bar. Personal contributions are in. Thank goodness, again, for Morrison, that the Labor government was going to knock that back. But essentially, personal contributions are in vogue. And really, there's no limit there. And you've heard me, and I'll talk about this a little bit later on, a little case study for us to think about around contributions. But we could have an employer making contribution, we could have a couple of employer making contributions, or even more than that, and we can still make personal contributions ourselves. So the old 10% rule is gone. And really, it's a great way, particularly for our clients who have got quite a bit of a tax liability. It's a great way of sheltering it. And of course, what will happen if we take a deduction this year, it's a concessional, whether it's an employer concessional or personal concessional, we get the deduction. As I said, the contribution has to be made. Made is for the trust. If it's going to be internet transfer, it has to actually hit the other bank account prior to the end of the year. Promissory note is when the trustee receives it. Remember that we talked about that earlier. So trust distributions. So we talked about the trusts before and then our trust distribution minutes. One is we need to go back and have a look at our trusts. You may not be aware, but we offer discretionary trusts on our Lightyear Docs platform, companies, unit trusts, so on and so forth. But when we go down and have a look at that, provided our beneficiaries fit within that framework, we can look at who our beneficiary is going to be. We saw Tim, and Tim's a great one that he loves his bucket companies, and I agree. What I would say is start to look around some of the family who we can distribute to. So there's two ways we can distribute to them, and they make a personal tax deductible contribution. So the limit there for us is obviously aged 75, making contribution on their behalf. Remember, we've got that 1 year post-retirement that starts from next year though. But effectively what will happen there is that we can make a contribution provided we can show that they work for 40 hours over a 30-day period. And remember, that can be self-employed or partially employed somewhere else. So, if someone can go out and get them. The main thing is then the trust distribution comes down to them. If they're 71 or 70 or whatever, then it'll come down to be assessable in their own name. But of course, they're going to have the low income tax offset, the new offsets, as well as if they're living off their superannuation income streams, obviously it's tax exempt. So they've got a bit of capacity. The beautiful thing about lump sums and taxable pensions is when they're received by the individuals, those payments are neither assessable nor are they exempt income, so they don't waste any losses, thank goodness. So when we get that distribution down to like a parent who might be 65, 70, again, they don't have to work specifically for the trust, they're just beneficiaries. They're provided they're a beneficiary, it's taken down in their taxable income, they can then make a personal tax deductible contribution up to the threshold of 25, and I'll cover going above the threshold a little bit later on. The beauty about that is that if they're over age 65, and again, we've got to make sure we meet the SIS test, we're allowed to do it under our trust deed, etc. Then when that's paid in, obviously it becomes, as soon as it hits the account, it becomes unpreserved monies and they can take it out straight away thereafter. So the only tax they're going to have to pay is obviously the contributions tax inside the fund. But if they've got franking credits, or one of the ones I'll talk about a little bit later on about minimisation, then we're in a pretty good position. And we could also use the children to a lesser extent, but I think we're going to look a little bit later on. I'm going to look at employee children. It's a little bit harder in order for a child under 18. I mean, obviously we've got adult children, but for a child under 18, in order for them to make a tax deductible contribution, then effectively they have to be in business or they have to be employed. So it's probably better to do it through a family trust than distributions, etc., particularly with under 18, the excessive penalties. So I love bucket companies, but if we've got some older members of the family, it's not a bad idea to shift it there. And we have to get used to that. So we need to look at a family trust as simply a bucket of income that, as Tim says, we can stream into a wide range of different entities. And for me, I love SMSFs. Transferring shares into an SMSF. So we can also do property transfers. As I said, you can do your capital proceeds. Don't forget, if you can do at year end, you can transfer. If you already own a property, you can switch it in pretty quickly at 30 June. You simply have to do a property transfer. You don't necessarily need to do an exchange of contracts. I've got all the documentation there if anyone needs be. But we can transfer shares into SMSF. Provided it's a business property transfer or SMSF, we can transfer them in, or remember that 1322C company I talked about a little while ago. Then there will be a capital gains tax or potential capital gains tax. Now, what we can do there is we can then use our deductible contributions or make concessional contributions to wipe out that capital gains tax. And I'll get to it very shortly, what we do from there. Employee contributions, again, have a look at the Lightyear Docs site. So all of the stuff I'm talking about is all available. All the documentation is available on the Lightyear Docs site for no more than $99, but for many it's just $49. So the employee contributions, don't forget to employ children and also parents, provided there's a genuine employment agreement. One thing there, if you have a look at, I think I did a session last year, when it comes around to contributions, you'll find that there's Ryan versus FCT. And I also put this in my latest Strategist, where I did a fully worked case study of business property going into an SMSF and getting deductible contributions. Anyway, there's a whole lot of stuff there, just a whole lot going on. For that one, with the Ryan's case, a contribution was allowed to be put into superannuation up to the age-based limits, which was $100,000 at the time. So this was in early 2000s. The Commissioner argued that the contribution going in was for one of the directors and it should have been treated as a dividend. The court struck it down and basically said that superannuation is excluded from those relevant provisions, which is Section 108 and 109. Now, what happened there is Commissioner also has done a ruling on the issue and is also exactly that sort of case where a part-time employed a person who's helping out a contractor, provided they're genuinely employed, there is no limit on the contributions, the deductible contributions that are made from a tax perspective. So they will get a tax deduction for it under Section 290(160), I think it is, or 291(160), one of the two. So 290(160) for an employer. Plus Part 4A does not apply, even if they don't work to the same extent. It's a great little grab straight from the Commissioner's ruling on contributions. It's honestly, it's my favourite all time, and I love rolling it out at tax time. If you need to get a copy of it, Daniel at ilovesmsf.com. Okay, concessional contributions do not have a cap. Finally, I've been talking about this since 2013. They're just different tax consequences. The government did make change. Remember that prior to that, there was a flat rate of tax on excess contributions. And I saw in the SMSF advisor email that went out yesterday, someone's actually talking about making excess contributions to see what it is. And I think we all really need to get on top of it. First off is there is no cap, there's a threshold. So if we go above a threshold, then it's to be added back to the member's assessable income, as many of us are pretty aware. And then we have an excess concessional contributions charge, I think it's around about 6%, which is based on the add back of the taxable income. So it's not the actual contribution that's excess, it's only the assessable income. So to me, look, it's quite generous, because remember, we've got potentially a different time frame, and more importantly, we're getting rid of assessable income now. So if we go through and have a look at my strategist article, it's one I sent through just recently after I did quite a lengthy session. I think it was a 3-hour, 2.5-hour session with those who are on my CPD, and we went through the whole situation. There we had a fully worked situation. There was a retired member of a family, and they were in receipt of deductible contributions of $75,000. At the end, they personally only paid $300, and that included the CCC's concessional contribution charge. And the reason for that was a couple of things. One is they were living off their pension income. So their normal income, well, in fact, for your clients, if they just live solely on pension income, then they don't have to lodge a tax return in the year for just pension income. In fact, they can stop lodging tax returns if that's their sole source of income. But obviously, if we're going to add back, then we've got nil income. We have to add back if it's $75,000. I've got $25,000 of concessional that I don't add back, $50,000 I add back. I work out my tax liability on the $50,000, but then I get a 15% tax offset, which is essentially why I only end up with $300. Importantly for that one is that when it goes into the fund, I get a deduction. Obviously, it's going to be a taxable contribution into that fund. And I've just got to be careful there because I'm going to have to look at minimising that. If I've got franking credits there, that's great. But we'll talk about some of the minimisation rules a little bit later on. Non-concessional contributions are 100K this year. And unfortunately, you'll start to see from next year, this is the first year of the 5-year carry forward. Unfortunately, we can't go back earlier. So if we don't make up to our 25,000 threshold, we can pick it up again next year. So that's for the 2020 year. We can't carry forward well, we can actually do a 3-year bring forward for them, but we can't carry back. So non-concessional is forward, concessional is going to be going back. So this year, if you don't use your 100K, then you use it or you lose it. Contribution suspense accounts, the Commission doesn't like them to be called contributions reserves. For those of you who are on my CPD program, I did quite an extensive strategist, I think it's 24 pages on both the reserves and also looking at the Commissioner's ruling or guidelines on reserves. One of the things he said there is he doesn't believe that they're contributions reserves. And look, personally, I don't care whether it is or not, as long as it's the impact which is I want. If he calls them suspense accounts, then Grant's got his hand up and saying, yep, I'm with you, Commissioner, I'm calling them suspense accounts. A few years ago, I would have called them reserves, but no, if you give me a thumbs up if I call them suspense account, why would I rock the boat? So you'll see on Thursday, we'll be launching our contribution suspense account. So make sure, I will send the thing there, but particularly your admin staff, looking at trust distribution minutes, contribution suspense accounts and promissory notes on Thursday through Lightyear Docs. So have a really good look of that one. They'll come up and running from that. So let's have a look at a contribution suspense account in practice. And I think you're going to have a little bit of fun on this one. So let me just play around with this a little bit. So sorry about the formatting, that's probably my problem. Let's play. So what I want to do is I want to contribute 125K of concessional contribution this year. So again, just play with me and I'll play out the system. So what I'd like to do there is put the contribution in, and for that one, essentially what I'm going to do is I am, just hold on a second, just check. Oh, Tony, Tony Anamoulis, my best mate, is on the call. So thanks, Tony. He's our person who signs off from TGA Legal. So heads up for Tony. So let's get back to the case study. 125K concessional contribution this year. So that's going to get rid of quite a significant amount of assessable income, as you'd agree. So 125, and then I'm going to contribute 500K of non-concessional contributions this year. So our clients are awash with cash. Now remember, this could be by way of shares. It could be, for example, quite a sizable share portfolio, and we need that 125K to get rid of our capital gains tax. So this is what I would do for contribution suspense. If I did it all in the income year, this income year, I'm obviously going to have a problem because I can use my 3-year bring forward. So it means I've got 200K of excess concessional. Now, the other problem I've got is I've got 25. And again, if I do all of this year, as I said, I don't mind adding back the 100K of excess concessional and working out my tax liability on that, less obviously the 15% tax offset in ECC. The problem is where I go into excess concessional, that is treated as non-concessional. So I would only be able to put in 200K this year and I'll be 300 excess. So what I'm doing now is I'm using a little jiggery pokery, and hopefully with me, I'm going to take it slow so we can work it out to make sure that we've got our carry forwards. Someone's got, so Salvatore, can the excess concessional contributions be a useful strategy where a client has carry forward revenue losses? Probably not a big one, Salvatore, because the problem is where we get, if it's a company or a business, it's fine because the deductions will actually be a carry forward. But if I'm getting concessional contribution, a deduction, you'll find that personal contribution deductions, if you're in a loss position, you don't get the deduction. So sorry about that one. But again, if you've got any of these sort of questions, contact me, Grant at ilovesmsf.com. Paul Gorry, is income reserving still okay to use? Absolutely. If you have a look at the Commissioner's ruling, as I said, I did probably about 2 or 3 webinars on that last year and also really pulled apart his ruling. Income reserving is still okay. You can't use general reserves, never really you should before. Roddy Orientia, I'm going to come back to this session. Can my SMSF and my sister jointly buy vacant land and thereafter build a house, either at using existing primary as security or using the new property as security? Property purchase tenants common. Roddy, if you want to come back, are you looking at doing it inside an SMSF or just ordinarily? I'll come back and have a look at that if you can elaborate. Anyway, let's go back. We've got 125K of concessional. So that means I'm 100K over, which I'll get a deduction this year. I have to watch out for the 125 will be assessable inside the fund. The 100 there'll be another 100, which will be non-concessional. I've got 500. So for me, I carry forward 100K of concessional contribution into a suspense account. So is everyone with me on that one? So I've got 125 in. For that, my contribution is 125, but effectively I've only got 25. So I'm carry forward the 100K. And what that means is my excess is actually carried into the next year. Is everyone with me on that one? So I'm not going to have to pick up or add that back to assessable income for, because it's going to be picked up next year, will be in the 2020 year. So I'm not going to have to do an add back until when you lodge the return, which is probably going to be March 2021. Has everyone got that one? Whereas if I left it as is, then my add back is going to happen in March 2020. So by flipping it over, and I'm a great believer in flipping over concessionals, by using that suspense account now, I'm taking it into the following income year. And if I can manage my tax liability, does everyone understand if I do the add back? If I can manage my tax liability next year, then effectively my add back will actually be a lot cheaper because I've got different marginal rates. Now, carry forward of 400K of non-concessional. So what I'm doing is I'm throwing that all into, I'm taking 100K this year and then carry forward 100K of non-concessional. So effectively what will happen though is that 400K of non-concessional goes in. I've got 100K this year and then next year will pop up, which means then I've got 300K of non-concessional bring forward rule, depending on what my age is, of course. That would leave me with 100K in excess of non-concessional, and also I've got the other 100K non-concessional from the bring forward. So I'll end up with a couple of 100K. I think that's going to be the case. So 100 yeah, I think it's a couple of hundred K. It's either 100 or a couple hundred. I'll come back and work on that one of excess non-concessional. Because that's brought into the following year, then what will happen is that will be, I'll get assessed on that, and then the Commission will notify me probably around about probably around about May, or do an assessment notice that I have to draw that 100,000 out, or whatever the excess is, 100 or 200. Sorry, I'm just doing this on the fly. What happens to the add back, ECC, NC rollout? So obviously you've got 90 days to, when you get notice that there's excess non-concessional, just simply draw it out of the system. But you can go back and put it back in as an excess concessional again, or concessional again, and go through that process. If it's a business real property transfer, then we might be using a mix of concessional, non-concessional capital proceeds, or the $500,000 CGT exempt component. So we've got quite a bit of stuff there, and take it from there. I'll just move on. So contribution to suspense account, absolutely crucial. Make sure you load up with a lot of concessional and also non-concessional, and take it through from there. Okay, so keep on going. I want to start minimising the taxation inside the fund. First off, imputation credits are awesome. So obviously clients have got existing imputation credits, which is fine, but the fact if they're refundable, they're refundable. If you've got kids inside the fund, which, I'm a great believer of the family, and 6-member funds are on the way very shortly. What we have from there is the kids' contributions tax will be automatically absorbed by the franking credits. Now, one of the issues you'll have to look at there is, is there an inter SMSF payment from the kids' accounts to the parents' account for use of those franking credits, much the same as they do with industry and retail funds. That's really, it's a question to raise for a lot of the clients. Some clients are quite happy just to let it slide and give the kids a bit of a ride on their contributions tax, which is fine, particularly if they've got quite sizable amounts of imputation credits. So, but if we're running out of imputation credits, if you generally need it, you guys know probably a lot more, and we've got some pretty experienced planners listening in here, like Paul Gorrie and also Tim. Obviously, there's imputation funds. They pay imputation credits. They distribute at 30 June. Quite often you don't know until a little bit later, but at least they'll come with imputation credits. So do some research there. You might be able to get into a managed fund or an imputation fund and see who is going to be paying the most imputation credits. Other tax, salary continuance, life and TPD, effectively they're all deductible, so don't forget to talk to clients. And if you've got a family fund, look at using the earnings of the fund, if there is cash flow reserves in there, using those to fund insurance for the younger members of the family, which is quite useful. Audit insurance, absolutely. I believe that that's absolutely crucial. And general insurance if there's a property. Prepaid borrowing. So if it goes to a bank, obviously prepay your interest. It depends on if you've got P&I, you're stuck, but prepay your interest if that's the case, at least you get a deduction. Just watch out related parties. The last thing you want to do is prepay and find out you end up getting an interest deduction inside the SMSF at 15%. And then you find that it's accessible in their hands at their top marginal rate. So related party loans don't prepay, anyone else prepay. Much the same as Tim said, thumbs up, prepay accounting administration fees. As I said, Tim makes $160,000, gets that income in, and good on Tim. So that's why he's got such wonderful cars, Aston Martins and all that, because he's a smart strategist. Some more things. We're getting towards the end now. Look for early stage innovation companies. There's a few around. There's quite a few poking their heads up. Just be careful. Obviously, they can be quite risky. But if you get an early stage innovation company, then if you put in $20,000 into that company, getting a 20% tax write-off, so that's effectively a $4,000 tax break, which would shelter probably around about $4,800 of taxable contributions. The beautiful thing about it, and of course you can do ESIC outside as well, if you've got extra cash outside, it's a great write-off. It's only 20%. I like it going into the SMSF. But particularly for the younger guys in the accumulation stage, it's a good way to get rid of their contribution tax liability. If it sits in there, you've got a CGT exemption, and if you dispose of it within 10 years, then it's tax-free. Don't forget the instant asset write-off. I had a really good question with Chris Becks from Warrnambool, beautiful place of the world, who said that one of his clients got commercial property and it's leased back to a related entity. They want to put solar panels on the roof for a couple of reasons. One, instant asset write-off, and also the Victorian government gives you a bit of a slug or a little bit of a benefit there. He asked whether that could be done with the instant asset write-off, because his auditor said unless it's a trust or a company or a partnership, you can't get instant asset write-off. Well, instant asset write-off applies to taxpayers who employ it in their business. So with that one, we'd need to obviously go through that, and if it becomes a fixture of the property, we just got to be careful with fittings, because fittings, if they're detachable, we could get in trouble if that is now going to be leased back to the related party, because that in itself may effectively be an in-house asset. But generally, if it's not, then you're okay. So that should be okay, Chris, the solar panel, if you go and have a look at the instant asset write-off. But I'll come back and I'll just do a little bit more research on that one as well, have a look at depreciables. Another one is a good one for clients, upgraded clients' deeds. If you haven't got them on annual upgrade, certainly we've covered all the latest strategies. I think our deeds are only $99 if you want to do a variation. Saw someone do 100 variations the other day in about a day and a bit. So it's a great way to get all your clients in. We've got deed upgrade letters there that are very, very strong. So certainly worthwhile. But the client gets a tax deduction. And so this is another variation of Kim's stuff. It's a deductible expense, but it's also a good income earner for you. If you can get 50 client upgrades at $400 a pop, which seems to be about the going rate, that's around about $20,000, particularly if you're only buying it from us for $99. That's a good little profit earner. And of course, investment strategies, you need to complete them from the 1st of July along with minimum pensions. So there's a few little things coming in from there. Let me just go through. I've got a few little things there, but I've got a couple of questions I want to cover. Before I do that, just let's have a look. Those of you who've seen our Light Year docs, we've now got 40 docs on, and we've got around about 2 or 3 jumping up a week. We've got a deed of gift coming up for family trust distributions. We've got some pretty esoteric ones there. We've got we're looking at a deed to wind up or wind up a discretionary trust. So just watch out for those things. They'll be coming down the track. Of course, we do companies, discretionary trusts, 1322C companies, so on and so forth. Just got a bit of a year-end, some deals, unlimited documents. So just use a docs for $99. But for those of you who want, we've got unlimited document, a monthly subscription coming out now if you want, $5.95 a month. But if you just want to, include that with firm-wide CPD, remember I talked about that. You're going to get, if you do the firm-wide CPD, that's 30 hours a year at least, which covers you for SEER. So certainly a cheap way of going. Prepay for unlimited documents. So if you want to do that, $69.50, invoice 30 June, so you get a deduction there in 4 monthly instalments. Or alternatively, you can get a 5-year unlimited documents for us. So that's a 25-year license. Again, that would be subject to the instant asset write-off if you want to go down that track. Again, we've got, actually, thanks, Tony. Thumbs up, our tax guru says solar panels are fixtures in my view. So again, that's perfect and wouldn't have an in-house asset. Last thing you want is a detachable in-house asset. For those of you who want 5-year unlimited documents, the board's given me 20 of those, and already 6 are gone. So 25K, it's tax deductible, but it needs the fixed 5 years. You get unlimited documents from Light Year Docs, strategies, and also CPD. Given the fact that CPD is worth about $17,000 or $18,000 for that, it's an awesome offer. In fact, we've had a couple of people put it in unit trusts where it's superannuation unrelated investment trust, where a couple of partners have got their super funds investing in a licensed trust that they then offer back to their business. But again, we've got some crowdfunding coming soon. It's very exciting. We're looking at obviously building the business. The reason we can keep our docs so cheap is because we've spent a whole lot of money getting a really reliable system. So we spend the money on the docs and not necessarily having to do the development. So that exciting opportunity allows you to be part of us. So just watch out for that very shortly. The other one that we want is, I just got a couple of questions here. Rod came back and said, I wanted to purchase property 50% inside the SMSF and balance 50% as we purchased by my sister on a personal basis. A couple of things there. Not a bad idea, Rod. First off is, if you're looking at doing that, you could do a joint venture on that particular element. So with a joint venture, the super fund could buy the property and then effectively the sister could then use the monies to build on that property. She could use the existing primary home as security, so that's okay. The property will actually be then owned tenants in common, which is, again, that's just a straight joint venture arrangement, is a better way of doing it. But obviously no related party can live in it because it's residential property. But look, it's all doable. Roddy, if you want to just send me an email to grant@ilovesmsf.com. Now you've got a property as residential, and what I can do is I can flick it on to Tony Anamoulis from TGA Legal, and he's put his hand up and said he'd love to have a look at that. You know, he does. He's like our property specialist. So the question from Salvatore was, an employer paying 100K into super. Thank you, Salvatore. That was okay. Remember, we drifted back there. That 100K, if it's a personal contribution and we're in losses, effectively we don't get the deduction. The deduction's wasted. But effectively, if we have got the concessional contribution, the losses, then that will just add to contributions carried forward. And again, Salvatore, please feel free to send an email to Daniel or grant@ilovesmsf.com. So we're almost up to time. A couple of things. If you haven't had a strategy session with me, they're a lot of fun and it gives you an opportunity. There's no cost on that. You can just bounce any ideas or strategies or whatever past me. Just contact Daniel@ilovesmsf.com. Choose one of the above options in terms of like your docs. From my perspective, if it was me, I'd go the 5-year unlimited because I think that's a bit of a no-brainer. But, it doesn't matter. $99 PAYG documents is pretty good. I mean, why pay $400, $500? And just watch out for our crowdfunding. It's pretty exciting. We're certainly in it to change and make sure your business is as best as possible. Anyway, there's some of my pre-30 June, and don't forget on Sunday of the 30th of June when you're sweating because a client wants to get a deduction or you need to, don't forget you can get that little promissory note off us, send it off to the client, get them to sign it, scan it, and give it to themselves, or they just have to sign it, give it to themselves if they are the trustee of the fund. And then that should be all okay. Anyway, it's you get our CPD from that. I'll send out this recording shortly with Tim's recording as well. A couple of other little issues there. And we'll send out a survey. If you complete the survey, then you get one CPD from FBA, SMSF Association, and also under FASEA, as it's broken down into its relevant components. So again, great to see some of you on there. Salvatore, thanks again, Paul. Good to see you there, and also good mate Tim. And can't wait to get and see you in September the 2nd to be in Brisbane for his big Change Accountants roadshow. Anyway, it's Grant Abbott signing off, and great to have you on board. And let's get ready for the next financial year. It's going to be a big one.